Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
The tariffs that Trump announced on steel and aluminum, he has postponed until March 12th, so basically a 30-day reprieve. But in reality, it's going to be hard for Canada, which is the primary export for us anyway, of their steel and aluminum. Mexico too, but primarily Canada. We get most there, to kind of figure out their border situation. So this is very much focused on threats to get the border cleaned up. Mexico has been playing nice in a sandbox with Trump, but they have a massive issue of cartels to deal with who are not happy about every car being investigated in Tijuana and or the troops that are being deployed and the shutdown of immigrants, et cetera, et cetera. So Canada has completely refused, really, and that's the problem. So he's adding insult to injury, which is going to be inflationary. So for example, the same day that Trump announced new steel tariffs, U.S. steelmaker Nucor just did their earnings, right? Immediately sent a letter to customers of price hikes. So that's for their rebar, which is a core input for construction. So real world tariffs, even if they are not in place yet, they're not going to take the loss. Right? They're going to immediately start pricing this in because contracts are also hard to rewrite on tariffs. So they're already anticipating and they're already putting this in play to the consumer, which is of course the company that uses the rebar that then gets passed along to the prices for consumers. So that is inflationary, and folks that say tariffs really aren't. I am looking at the oil that is still kind of moving higher, and we got a little pop here in yields. Dollar is soft. Gold took a little header here back down with silver. Remember, this is going to be a very, very kind of fragile thing because of rumors going around that you've got a lot of supply issue, right? At Bank of London and margin calls and the rest. But at the same time, you also have Besant out there talking about a sovereign wealth fund, and you need assets for that, right? Or his other comment last week about monetizing U.S. assets. So maybe they're taking delivery of gold. I'm not quite sure how they're going to make income off it, but the point is gold is getting bid up on some of this talk, right? So the sovereign wealth fund, what's an asset, and monetization of assets, and other reasons, of course, London, margins, etc. But the point is, look what it did. It ran all the way back up here into this kind of 269 area. See the fib level? I got to throw something on here when we're in blue skies. And it hit literally 268.66. That's close enough. And it's starting to soften a little bit. I am a little bit more cautious about gold at these levels, specifically GLD and silver. They've run really strong. If they go parabolic, something's really wrong. Right? And those are some of the kind of justifications I'm finding for why gold has been bid up. We know about China has increased its allocations, as central banks have been doing. Russia has been for a long time, doesn't need treasuries, and they're using gold to settle their trade terms. China has increased their gold holdings and decreased treasury holdings to the tune of 32% since 2019. You know what has really, really picked up? Bank of England, the UK, has increased treasury holdings 169%. So you know that one doesn't need us and the other does desperately. So, UK, vassal state, Japan, vassal state, however you want to clarify them or classify them, I don't care. The point is we definitely don't have China increasing treasury holdings. And this morning, we've got a little shake and bake, but it is kind of a big deal yesterday that we ran up so much. So gold and silver taking a little pause. The dollar still is intonating a roll over, but it has not. Big picture, I'm just looking at stuff that will go into earnings, of course. And we've got oil making a bounce, even though it could be some shorts covering or geopolitical. We do have Trump, by the way, and I should point that out. Trump is saying, hey, if the Hamas leadership does not release the rest of the hostages by Saturday, that he will basically order the end of the ceasefire and hell and brimstone, or I forget what expressions he used, but it was all very, threatening. He's really, we really don't have a safe, I would say, bet with him not escalating in Iran. That's still a danger. And then, of course, today talking about giving, at some point in the future, Ukraine will probably be Russian controlled. So he's really, he's picking fights everywhere. But pick your fight. pick your fight. Right now, oil's having a little bounce, and I know that there are some very, very unhappy folks over in the Middle East about his comments on Gaza, about his escalation chances with Iran, and with what happens if Hamas does not release hostages on Saturday. So you have absolutely a war premium that's getting priced into oil this morning. So those are kind of critical factors here. He's really starting to stoke that fire on purpose. Gaza, Iran, and Hamas, all these statements are very inflammatory and inflationary. I will say that bonds are having a little bit of a tap back down. Why? Oil is rising, yields are rising, kind of this inflationary war vibe. And that's important. This war vibe is inflationary. It is very much a bond rater's dream. In other words, you short bonds because war is inflationary, that kind of stuff. Now, of course, he could create peace. And then that's my whole thesis that I wrote about, right? Peace is actually very supportive for bonds. But ironically, look at where we got tapped down. This is the 10-year T-note futures, right? This kind of, again, head and shoulders, but really nice overshoot. And boom, we got right back up, formed this pattern. And I said, this is where price target is. It is literally the 10-year, and I can show you in TLT, but you got the point, right? This was where we broke down, and this is where I expected we would come back and tag. We did, and then this softening. So far, this is really happening like on cue. But the point is, this is the yield bounce right now with oil, or following oil, however you want to put it, that is making the equities a little softer. So we would have to have follow through. We'd have to have follow through in a yield spike, in an oil spike, for equities to get sold off more.
Join Club today to engage with Samantha and her team of 10 experts. Scan this QR code or click the link in the description. Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.